Welcome to the February 2026 edition of This Month in Payroll. I'm Claire Soccio, leader of PwC's Workforce Practice. In this edition, we will focus on Part 2 in our year-end preparation series, being reportable fringe benefits and reportable employer superannuation contributions. A recent decision about amendments to the agreed working hours of a part-time employee, and further developments relating to Payday Super. Last month, Alana introduced our year-end preparation series, with Part 1 exploring the value of a pay code health check. In this Part 2, we're discussing reportable fringe benefits and reportable employer superannuation contributions, which are also known as RESC. These items are essential to the single-touch payroll finalisation process, and mishandling them can lead to downstream issues, affecting employer compliance with the ATO, and also impacting employees personally, since these amounts are used in income tests for family tax benefit, child support, Medicare levy surcharge, and help repayment thresholds. Let's review what payroll teams should be considering now to ensure timely and accurate year-end reporting. First, to reportable fringe benefits. If the total taxable value of an employee's fringe benefits exceeds $2,000 in an FBT year, which runs from 1 April to 31 March, the employer must report the grossed-up value of those benefits on the employee's income statement. The grossed-up value reflects the pre-tax salary an employee would require, at the highest tax rate of 47% including the Medicare levy, to purchase the equivalent benefit after taxes. For the 2025 to 26 FBT year, this uses the Type 2 gross-up rate of 1.8868. No reporting is needed if the benefits are $2,000 or less. Once the threshold is exceeded, the entire grossed-up amount must be reported. That is, there's no pro rata or incremental reporting. So what steps can payroll take now? Teams can plan now for close cooperation between payroll and the finance or tax team preparing the FBT return. By early June, it's ideal to have a final list of employees and their corresponding grossed-up reportable fringe benefits amounts, or RFBA values, ready for entry into your payroll system and STP reporting before the July deadline. Most employers follow the annual reporting approach described by the ATO, calculating RFBA figures after FBT year-end on 31 March and including them in a single STP update or finalisation event, rather than reporting progressively throughout the year. Some common pitfalls to avoid include the timing mismatch between the FBT year and the income year. The RFBA reported in the STP finalisation for the income year ending 30 June 2026 is based on benefits provided in the FBT year ending 31 March 2026. Confusing these periods, such as including or excluding the wrong quarter, is a frequent mistake. Don't forget terminated employees. If someone left during the year but received reportable fringe benefits, you must still report their RFBA. You can reactivate them for an STP update event if necessary. Entering RFBA in the correct designated field in your STP report and not adding it to gross wages. Under STP Phase 2, you also need to apply the correct indicator, being exempt or non-exempt, which depends on whether the employer is exempt from FBT. This is particularly important for not-for-profit and charitable employers, who may need to report both exempt and non-exempt RFBA for the same employee. And finally, make sure your end-of-year STP finalisation event is completed by the 14 July deadline. After that, the amount will show up in individual income statements via MyGov. Turning now to reportable employer superannuation contributions, or RESC. These are employer super contributions that exceed compulsory requirements, such as the legislated super guarantee or award or enterprise agreement rate, where the employee has negotiated, influenced, or directed the amount. The most common examples are salary sacrificed super contributions, or where an employee has negotiated a higher contribution as part of their contract. RESC amounts are not included in taxable income, but similar to reportable fringe benefits, are recorded separately for certain income testing purposes. There are a couple of common errors to be particularly mindful of. One being, with STP Phase 2, salary sacrifice to super is reported under its own label, Salary Sacrifice Super, which is separate from gross wages. However, if the sacrificed amount also qualifies as RESC, it must be reported in both fields, as salary sacrifice and as RESC. They serve different purposes, and omitting either will result in incomplete reporting. Secondly, with recent increases to the compulsory SG rate, the threshold for what constitutes additional contributions has changed. Now, only contributions above 12% are regarded as RESC. This is worth reviewing closely, particularly for employees on older enterprise agreements or individual contracts with fixed super contribution rates. So what can be done now? To prepare for STP finalisation, you can run a reconciliation across all salary sacrifice super amounts and any additional employer contributions, cross-referencing these against salary sacrifice agreements and internal records. Make sure compulsory SG has not been inadvertently included in the RESC figure. For both RFBA and RESC figures, the consequences of getting it wrong extend beyond the employer. These figures are used by the ATO and other agencies to assess employees' entitlements and obligations. Communicating proactively with employees, especially where a RESC appears on an income statement for the first time, is recommended. Clarifying that it's for assessment and not extra taxable income helps avoid confusion at tax time. Payroll teams will benefit from planning ahead, reconciling proactively, and working closely with the tax or finance departments. The data inputs for these obligations sit across multiple teams and systems, and a structured approach is the best way to support confident, accurate, and timely reporting. We'll turn now to a recent decision of the Fair Work Commission that considered the limits on an employer trying to change a part-time employee's working hours. In Poynton against Davmat Proprietary Limited, the Commission considered whether the employer, which operates an early learning centre, was able, under the Children's Services Award, to unilaterally alter the working hours of a part-time employee. Since September 2024, Ms. Poynton had been working part-time under a contract stipulating a minimum of 15 hours per week. Despite this, she regularly worked a 30-hour roster, being Monday to Friday from 9 a.m. to 3 p.m, which was confirmed in a written email exchange. Around a year later, Ms. Poynton asked for a flexible arrangement that would exclude Wednesdays from her schedule. In response, her employer suggested substantial changes, initially shifting her to 3 days per week, then subsequently offering 17 hours, split over 2 days, being Tuesday and Wednesday from 9:30 a.m. to 6 p.m. Ms. Poynton declined these proposed adjustments. The employer then tried to direct the roster changes based on a clause in the award, which allows employers to change the days an employee works with 7 days' notice if both parties can't agree to a revised schedule. The main question in this case, and what the employer argued, was whether this clause also applies to changes in the hours an employee works. The Commission disagreed, finding the clause establishes a clear rule. Changes to the agreed regular pattern of work may only be made by agreement in writing. The limited exception in the award is expressed in terms of days, not hours, or starting and finishing times. The Commission also reinforced the underlying workplace principle that regularity and predictability of hours is fundamental to the concept of part-time employment, thereby distinguishing it from casual work. Allowing an employer to alter most elements of an agreed pattern with 7 days' notice would render the part-time arrangements in the award redundant. The employer's operational needs, while acknowledged, did not make a unilateral change any more permissible under the award. The Commission ordered that the proposed changes could not be implemented without Ms. Poynton's written agreement. Similar part-time provisions exist across a number of modern awards, so this decision is not necessarily confined to the Children's Services Award. Employers should understand what any applicable awards permit when it comes to varying part-time arrangements. Many awards draw a deliberate distinction between days and hours, and the ability to change one does not automatically extend to the other. Secondly, The written agreement on a part-time employee's regular pattern of work, often established during onboarding, carries significant weight. Employers should ensure these agreements are documented carefully and should not assume they can be overridden by a contract of employment or operational preference. And thirdly, if a change is needed, the starting point must be genuine consultation and good faith effort to reach agreement. In this case, the Commission observed that the employer's communications were largely directives rather than propositions inviting meaningful feedback. Now to Payday Super, which we've covered in detail across previous editions, so I won't revisit the fundamentals here. But there have been two recent developments from the ATO that are worth flagging as employers enter the final preparation window before the 1 July 2026 start date. The first is the release of Practical Compliance Guideline PCG 2026/1, which sets out the ATO's compliance approach for the first year of Payday Super. This is an important signal from the ATO about how it intends to exercise its compliance resources during the transition period. As foreshadowed in the draft guidance we discussed back in October, the guideline establishes 3 risk zones: low, medium and high, and the ATO has been clear that it will prioritise its resources accordingly. Employers in the low risk zone are those who make a late SG contribution, for example due to a fund rejection, but they correct it as soon as reasonably practicable. Under the compliance approach, the ATO is not expected to apply compliance resources to investigate or review these employers. The medium risk zone captures employers who identify and correct any SG shortfalls within 28 days after the end of the relevant quarter in which the earnings were paid. These employers may be investigated, but are expected to be a lower priority than the high-risk cases. High-risk employers are those with one or more SG shortfall that is not corrected within 28 days following the end of the relevant quarter. These employers will receive the ATO's highest priority attention. The guideline includes worked examples illustrating how employers might move between zones, which is useful reading for payroll and tax teams assessing their readiness. Importantly, this guideline only applies to the first year. From July 2027, the standard compliance framework is expected to apply. So employers should treat this transitional period as an opportunity to embed the right processes and strengthen data quality, not as a reason to delay implementation. This month, the ATO also released a handy Payday Super checklist for employers, which sets out clearly the practical preparation steps you should be completing to support your readiness to comply. Some examples include reviewing cash flow, updating payroll governance and business processes, understanding the new qualifying earning concept and how this impacts the calculation of SG, and refining error identification and correction processes. The ATO's compliance posture will reward genuine effort, but it is unlikely to extend leniency to employers who don't make appropriate attempts to transition. We've been discussing Payday Super across a number of months now, and if you aren't already well progressed, prioritising preparation is now time critical to support a successful transition. And that's it for our February edition of This Month in Payroll. If you'd like to revisit any of our prior updates, they're available on our website at pwc.com.au/payroll. And if you have any questions or need for support, please reach out to me or your usual PwC contact. Until next time, have a great month in payroll.